Welcome to this module on market structure, volatility, and liquidity. These three concepts form the foundation of how all financial markets operate. By the end of this session, you'll understand how they interact and how they impact your trading decisions. To trade successfully, it's not enough to look at price charts, you need to understand the environment behind those prices. Market structure explains how trades happen. Volatility shows how fast prices move. And liquidity tells you how easily you can enter or exit trades. Let's dive into each one, starting with market structure. Market structure refers to how buyers and sellers interact to create prices. It's about the mechanics of how trades get matched, the flow of orders, who's buying, who's selling, and how prices are discovered. Think of it as the engine that powers the market. In a visual sense, imagine a diagram showing buyers and sellers connected by a market maker. That's market structure in action. There are four key components of market structure. First, the participants, retail traders, institutions, brokers, and market makers. Second, the trading venues, exchanges or over-the-counter markets where trades take place. Third, order types, such as market orders, limit orders, and stop orders that determine how trades are executed. And finally, price discovery, the process through which supply and demand interact to set the price. A good illustration here is an order book, showing bids and asks price. Markets tend to move in cycles. There are three typical phases: accumulation, manipulation, and distribution. During accumulation, smart money is selling quietly. Then the market moves into a downtrend as we enter manipulation. Distribution happens near the bottom when professionals start buying. Finally, the market shoots up in an uptrend. Recognizing these phases helps traders time entries and exits more effectively. Now, let's talk about volatility. Volatility measures how fast and how much prices move. In high volatility markets, prices move sharply and frequently, offering more opportunity but also more risk. In low volatility markets, prices move slowly and predictably. You can visualize this by comparing a calm price chart with one that has a wide-ranging candle. That's the difference between low and high volatility. So, what causes volatility? Economic announcements, central bank decisions, and geopolitical events are common triggers. For example, when inflation data or interest rate changes are released, traders react quickly, causing sharp price swings. Even market sentiment or thin liquidity can increase volatility. In practice, you'll often see volatility spike during major news events. Liquidity is about how easily an asset can be bought or sold without changing its price too much. In a highly liquid market, like major forex pairs or big stocks, there are plenty of buyers and sellers, so trades happen instantly and spreads are tight. In a less liquid market, such as small-cap stocks or exotic currencies, there may be fewer participants, meaning wider spreads and slower execution. A good visual here would be comparing two order books, one deep and full of orders, and another thin and empty. Liquidity can be measured in several ways. The bid-ask spread is one of the most common. Narrower spreads mean more liquidity. Trading volume also matters. Higher volume usually signals more active markets. And finally, market depth, the number of buy and sell orders at various price levels, tells you how robust liquidity really is. Liquidity and volatility are closely linked. When liquidity dries up, for example, during off-hours or major news events, volatility usually spikes. That's because fewer participants mean price moves more sharply with each trade. On the other hand, when liquidity is high, prices tend to be more stable. So, in short, low liquidity means high volatility, and high liquidity means stability. As a trader, you can use this knowledge to your advantage. Trade during high liquidity sessions, like the London or New York Open, to get tighter spreads and better fills. Adjust your position size in volatile markets to manage risk. Use limit orders to control your entry and exit prices. And always keep an eye on economic calendars, because major announcements often trigger spikes in both volatility and liquidity. To wrap up, market structure explains how prices form. Volatility tells us how fast prices move. And liquidity determines how easily we can trade. Together, they form the foundation of all trading environments. By mastering these three elements, you'll understand not just what prices are doing, but why they're doing it, and that's the key to becoming a more confident trader.